This may surprise you. 17% is a yield on a brand new ETF. That's not a covered call fund. It's not a REIT. It's something that until very recently, only hedge funds and ultra high net worth investors were even allowed to touch. You see, hedge funds have been hoarding this strategy for decades while you've been stuck with the crumbs. I'm going to show you exactly how to crack the code on this institutional only income so that you can start collecting those fat monthly checks yourself. I spend way too much time obsessing over high yield math, so you don't have to. People DM me every day asking me for that number, and today I'm going to give you the keys to the vault. Stay tuned. Most of you are looking at covered call ETFs and thinking that's the ceiling. It's not. There is a specific instrument called an auto-callable that was essentially off limits to us until now. It doesn't rely on selling calls on stocks you own. It relies on a barrier in a major bank, JP Morgan, being on the other side of the trade. There's two ETFs that I'm going to talk about today. One is CAIE and the other is CAIQ. Now, before I dive into the mechanics and specifics of it and giving you the pros and cons, allow me to play a snip from the CEO of Calamos talking about specifically CAIE so that it sets it in context for you.
Team to launch this. It's the first auto-callable income ETF on the market, and it's something that's going to revolutionize a lot of the market. It's already over $100 billion market. Before this, it was only available to people that were extremely high net worth. So we're talking about the minimum buying was at least $250,000. There were K1s involved. It was very intricate. You had to reset all the options all the time and buy the notes. This is what we call the easy button. Hit the easy button on this, and it's available to everybody as an ETF format, traded daily, liquid, with high income, which is phenomenal. Our coupon came out at 14.7 and pays.
I want to take a little breather here and state that this interview was done in 2025, so the numbers are going to be a little different as I go into more recent data on this fund. So I just wanted to state that. Let's go back to the interview.
Monthly, which is fantastic. And the only downside is if the market falls below, it takes a hit of over 40% in the equity markets, then you start to see a little deterioration of your coupon and then possibly your principal, depending on how long it stays there. But
what the CEO talked about here is really safety barriers. So for CAIE, it's a 40% safety net. For CAIQ, it's a 30% safety net. I'm going to go into detail as I dive into the video, but it's something you also want to take a look at. It's a pro, mostly a pro, but it can be a con as well in case it falls below those.
This is something that we feel is going to really do really well. A lot of people have been asking for it.
So look, 17% usually sounds like a trap, right? But here's the thing. It's only a trap if you don't understand the math. For these funds, it all comes down to one number, and that's the barrier. That's what the CEO talked about. So if you were to invest in CAIQ, which is the NASDAQ version, you've got a 30% safety net. As long as the NASDAQ doesn't fall off a 30% cliff on the observation date, you get paid. Now, the S&P 500 version, CAIE, is even safer with a 40% barrier, although you take a slightly smaller check for that peace of mind. Now, here's the reality check, and I have to be very transparent with you. And this is something most finance channels are not going to say because it's uncomfortable. This isn't magic. You are taking on counterparty risk. You're basically betting that JP Morgan stays solvent and the market doesn't enter a total free fall past that 30 or 40% line. Now, is it likely? Historically, this hasn't failed since 2005, but you have to know what you own. This chart explains auto-callables in plain English. The bottom shows what the stock market does. The side shows what happens to your investment. The gray dotted line, that's normal investing. If the market goes up, you go up. If the market crashes, you crash too. Now, the light blue dotted line represents the coupon stream. That's the monthly income that you would be receiving if you were to invest in these ETFs. Now, look at the dark blue line. That's the auto-callable payoff. Notice how even if the market drops some, the investment stays near full value. And that is because these products have a downside protection barrier, what I was talking to you about, the 40 or 30%. Once the market falls below that barrier, that's where losses can happen fast. And if the market goes way up, your gains are capped. So the trade off is simple. You're going to give up some upside in exchange for high monthly income and partial downside protection. And as long as you understand the possible downsides, there's also many pros. What I have here is a chart of the index of auto-callables compared to the other major indices. And you can take a look clearly that the Russell 2000, S&P 500, and the NASDAQ 100 haven't really touched the auto-callables. The auto-callable growth has outperformed the equity on the previous three indices over the trailing 10-year period. Now let's take a look at the Calamos auto-callable CAIE ETF, which is giving you a 14% average coupon, and CAIQ, which is the Calamos NASDAQ auto-callable, at 17.7%, almost 18%. Now you will notice a third one, and this is Hedge, and the percent is actually pretty attractive at almost 24%, but it's just too young for me to do a proper digest on it yet. I may actually focus on it in about 6 months, but right now it's simply too young, too few assets under management for us to cover it in this video. As you can see from this chart, and when we compare income yields across different product types, the numbers are pretty striking. You've got your traditional options, your traditional aristocratic stocks on the left. You've got aggregate bonds. You've got even the covered call ETFs that are pretty famous by now, like a JEP or JEPQ. And then you look at the auto-callable income category, and the bars jump to 14% and 17.7%. And that's where CAIE and CAIG live. These are newer structured income ETFs built around auto-callable notes. And I want to be very clear that this is not financial advice. When you look at higher yield, it always comes with a different risk profile. And these are newer products without a long track record compared to the other vehicles. So I'm not telling you to buy anything. But if you're an income investor and you haven't looked at the auto-callable ETF space yet, this chart is a great reason to start doing your homework. And I'm going to be doing a deeper dive on CAIQ in about 6 months. So if that interests you, subscribe so you don't miss it. By the way, I wanted to wish all the moms listening to this a very happy Mother's Day. When I started this YouTube channel, I promised my wife I would keep my family pretty private, which is why I have an avatar, the man in purple. But I did want to share with you that there's a real me behind the scenes. I'm married and I have 2 beautiful kids. So I just wanted to share this moment with you. Wish you all a happy Mother's Day. If you have a mom that's still living, you are truly blessed. And for all the moms out here, hope you enjoy your day. I really hope you found some value in this and that you're pretty excited about the new options for auto-callable ETFs. And also, one thing that I did want to share with you is that I recently did a video on how much JEPQ you need to retire in order to build passive income. If that's of interest to you, please check out the video here. I want to thank you so much. Hope you have a prosperous rest of your week, and I will see you on the next episode.